today in terms of how this is fitting into the picture? Is the bull market on? What are your thoughts, Jim?
Well, right. I mean, Max, gold is up, 12 years in a row. It's up 500% in the last 10 years. However, it's down about 30% in the last 2 years. So gold has come off sharply. We all know that. But here's the way I think about it. Gold, pardon me, gold actually never changes. Gold is the numeraire. Gold is the way you measure everything else. So when you say gold is up or down, the way I think about it, gold's constant and the dollar is up or down. So when the dollar price of gold is down, which it is, what that tells me is the dollar is getting stronger. That's very bad news for the Fed because the Fed wants a weaker dollar. The Fed wants inflation. A strong dollar equates to deflation. So just hold gold constant. Think about the dollar price of gold coming down, which it has. That means that the dollar is actually getting stronger. That means the Fed's policies aren't working. Deflation is a central bank's worst nightmare, and that's what we're seeing. So when I see the dollar price of gold come down from 1900 in late 2011 to 1350 or so today, what that tells me is deflation is prevailing over inflation, and the Fed's got to try harder. The Fed's got to print actually more money. Now, you sort of have these two camps. You have the inflationistas, and I've been in this camp where you say, okay, gee, you take the Fed balance sheet from $800 billion to $3 trillion, on its way to $4 trillion, on its way to $5 trillion, which is what's going on. That has to be inflationary at the end of the day, and I think it does, but we're actually not seeing the inflation. And here's how to think about it. We have so many people are looking at the snapshot. They're looking at the time series of data and saying, gee, inflation's well behaved. It's about 1%, a little higher sometimes, a little lower other times. But that's like looking at a car that just drove off a cliff, looking at a snapshot. You look at a snapshot of a car that just drove off a cliff. There's nothing wrong with the car. I mean, there's not a scratch on it. But you know how it's going to end. It's going to end in a flaming wreck. And so I think we have to think about the dynamic and look forward a little bit and say, what's actually going on here? Well, what we have are two things going on at once. You have deflation, which is perfectly natural. It's what you would expect in a depression. Well, a depression means, among other things, people are deleveraging. When you deleverage, you sell assets. When you sell assets, prices go down. That makes things worse, and then they go down more. So that's the natural deflationary dynamic that one should expect. Against that, we have inflation from the Fed money printing, which is sort of artificial and policy-induced. So these two forces are pushing against each other, deflation and inflation at the same time. So it's impossible to estimate precisely, but in rough numbers, we might have sort of 4% deflation and 5% inflation at the same time, which net out to about 1% inflation in the CTI. But that's not a stable series. That's actually two forces pushing against each other. So think of it as a fault line where you have an earthquake. You have a fault line. Fault lines don't move very much most of the time. But every now and then they snap, and you have an earthquake, and it's massively destructive. So that's what's building up. Now the question is, when is it going to snap, and which way will it go? Will it tip to deflation or tip to inflation? We don't know that, but we know it will break eventually, and investors need to be prepared for both. Now, if it tips to inflation, then the inflationistas are vindicated. Gold goes, 2,000, 3,000. Eventually, my medium-term forecast is up to $7,000 an ounce. But if it tips to deflation, that's a completely different dynamic. Now, gold could actually go down along with everything else, but at some point, gold will skyrocket because the Fed will make it skyrocket.
Jim, in the 2007-2008 crisis, the system broke, Lehman collapsed, credit froze, and the central banks printed a lot of money. They came in to save the day. Well, here we are, 5 years later, the stock market's at a new all-time high, bond market's at a 300-year high. So why doesn't the Fed just stop printing? Why don't they go back to a normalized market? Why are they continuing breastfeeding this market?
Because the stock market would collapse if they did, and they know that. What's going on? The Fed's trying to create what's called a wealth effect, and I think we know this is a pretty well-known phenomena. More than 50% of the assets of the American people are in two asset classes, housing and stocks. So the wealth effect basically is, if my net worth goes up, if the net worth of the American people goes up, you feel better and you spend more. If you spend more, you get the velocity going, you get nominal GDP growing, you try to create the sustainable growth path, which we haven't seen. We haven't seen in this depression at all. So the Fed's been trying to do this. So by printing money, the money has to go somewhere. It's not going into velocity. It's not going into the consumer price index. It is going into to asset classes, basically stocks and housing. So they go up, and what the Fed hopes is that people feel richer, they spend more, but all that's happening is stocks are going up and people are putting more money into the stock market. They're not actually spending more. We're not seeing the change behavior in consumption and investment. We're seeing it in the stock market. So all they're really doing is creating another asset bubble. But what they hope is that eventually it changes the psychology and people start spending money. That's where they're trying to get. By the way, we've seen this movie 4 years in a row. Remember 2009, Green Shoots, 2010, the recovery summer, 2011, that was going to be the year we broke through, 2012. It hasn't worked 4 years in a row. It's not going to work now. It'll start to fade again, and then the Fed will print more money. They have no way out of this, Max. There is no exit in this policy.
All right, Jim Rickard, so what I don't understand, or explain to me a little bit better here, we've got a situation with, you say there's no exit strategy. Well, at the same time, the indebtedness is reaching all-time highs. New margin debt, stock market debt, household debt, corporate debt, bank debt. Isn't the Fed at this point printing money just to pay the debt? Because debt as a line item is gone from 15–20% of where these taxes are going. So isn't that kind of like the recipe for hyperinflation?
Well, it's the recipe, Max, but there's one missing ingredient in the recipe, which is velocity, the turnover of money. The psychology is not there. We are in a liquidity trap. I talked to some younger Americans, people in their 20s. They're saving money maybe for a down payment on the house or something. And what Bernanke wants to do is say, look, I'm going to pay you nothing on your savings, and if you want to make some money, you better go into the stock market. So he's trying to drive people into the stock market. But the people I talk to say, well, no, I think stocks are too risky. Maybe it's a bubble. I'm going to save more. In other words, if I can't get any return on my savings, I have to save more to get that down payment on the house. So rather than sort of breaking out of the liquidity trap by driving people into risky assets and pumping up the stock market, which is what the Fed wants to do. Sure, the stock market is going up because of margin debt, and institutions have to be allocated. They don't want to underperform. So that's definitely going on. But meanwhile, down at the level of the everyday Americans, a lot of them are saving more because they can't get any return. So you're actually making the liquidity trap worse. So this is the law of unintended consequences. As far as the debt story is concerned, it's, as Dickens says, it's a tale of two cities. We have fairly low interest on the Treasury debt, although the amount is huge. It's $16 trillion. So even a point on $16 trillion will cost you a lot of money. But meanwhile, over here in the consumer sector, a lot of consumer rates are 10, 15, 20%. And heaven help you if you're 5 days late on a payment. They jack it up to 25 or 30%. So people can't get out from under that. They're struggling. Savings, by the way, are near an all-time low. They went up a little bit on a precautionary basis after the panic of 2008, but they've come back down. So savings are really low. Debt to GDP is still going up. The debt crisis is nowhere near over. The Fed printing just keeps it from collapsing, but it doesn't solve it.
All right, Jim Rickard, that's all the time we have for